Good morning, good afternoon, good evening to those of you who have taken the time to join us on this important webinar, Countersin MSME Inclusion in Global Trade. My name is Deepesh Patel, editor at Trade Finance Global and host of the Trade Finance Talks podcast, joining you today from London. Micro, small and medium enterprises, MSMEs, are one of the strongest drivers of economic development, innovation and employment. Access to finance is the most critical barrier for growth for MSMEs, yet creating opportunities for MSMEs, particularly in emerging and developing markets, is key to advancing economic development and reducing poverty. We often speak about the 1.5 trillion US dollar trade finance gap, which has probably doubled as a result of coronavirus. We don't talk enough about the even bigger MSME financing gap, which according to the IFC stands at a magnitude of over 5 trillion US dollars. Countries have taken unprecedented drastic measures to contain the spread of coronavirus by restricting the physical movement of goods and people, disrupting millions of MSMEs around the world. So what are the biggest challenges in MSME financial inclusion and access to finance? And what lenses do we need to look at this from? Is it a regulatory, policy and trade reform perspective, a digital and digitalization perspective, or liquidity and financing perspective? Today, I'm joined by four fantastic panelists representing FIs, trade, policy, technology, and multilaterals. We have Claire Thompson, Executive Vice President, Enterprise Partnerships at Mastercard, Chris Southworth, Secretary General of the ICC United Kingdom, Nana Khurodze, Investment Specialist at Asian Development Bank, and George Wilson, Head of Institutional Trade at Absa and Board Member of the International Trade and Forfeiting Association. Great, so Chris, we'll start with you. If you can give a very quick 30-second introduction to yourself.
Yeah, I'm Secretary General here at the International Chamber of Commerce in the UK. I'm also Director of the new all-party parliamentary group for trade and export promotion in UK Parliament. And in the context of this conversation, I'm the founder of the ICC Digital Trade Roadmap.
Great, thanks. Nana, over to you.
Hello, Deepesh. I'm Relationship Manager of ADB's Trade and Supply Chain Finance Program, and I'm responsible for activities in Central Asia, Caucasus, Mongolia, and Pakistan. And our program provides loans and guarantees to developing member countries of ADB, taking risk either on banking sector or big corporates. Thank you.
Thank you. And Claire, over to you.
Thanks, Deepesh. Hi, Claire Thompson. I lead our global trade partnership group here at Mastercard, very much working with all the participants on the call. And so focused with development banks, financiers, data specialists in the industry, and networks. And really it's about collectively solving, obviously, this challenge and opportunity ahead of us. Thanks, Deepesh.
Thanks, Claire. And George, over to you from Johannesburg.
Hi there, George Wilson. I am an ex-lawyer and then investment banker in London, Hong Kong, and Africa. And I now work for Absa, a leading regional African transactional bank, and I specialize in financing African trade flows into, out of, and between African countries.
Thanks very much, George. So we'll start with some of the key challenges, and George, in fact, we'll start over with you. So framing some of the key challenges around access to trade finance, George, given your role at Absa, and given there's around a 120 million US dollar trade finance gap in Africa, What are the key challenges from your perspective?
Yeah, so it was 120 billion. With COVID, that's likely to have probably at least doubled. The key challenges around particularly this type of MSME trade finance, really stem from that trade gap. The ICC in their 2016 trade survey paper demonstrated some AFDB research, some African Development Bank research, that there was this gap, and it was comprised of very largely SME, including MSME, inability of African SMEs to obtain credit and financing from their banks. Now, that is the trade finance gap, and that's the problem that we're wrestling with. MSME trade finance in Africa, it is the local farmers and merchants getting credit from their local banks in their villages, towns, and cities on the continent to fund their buying and selling cash conversion timing differentials. And really only African banks can practically reach those hundreds of thousands of MSEs across the continent, understand them, have a relationship with them, and give them credit. And that's true even when they're organized into cooperatives. It's the local African banks that need to provide that finance. Now, the trade gap existed before COVID, and it basically stems from the fact that these local African banks are regulated as banks, and they're deterred from offering these types of trade facilities for their SME clients due to global regulation affecting the relative profitability of that business for those banks. And that's largely around capital and liquidity costs. These are commercial banks, and they must be profitable for their shareholders, and they're using finite, scarce capital for derivatives, scarce capital, and they can make a lot more money, and they can be a lot more profitable if they divert that capital into other products, other services for their clients, like derivatives and other forms of debt, and hence those banks, are diverting the lifeblood of trade finance away from MSMEs, and hence the gap. With COVID, the credit and liquidity strain, I'm afraid, has only become worse. And the gap will widen, and the capital of those African banks has shrunk, the capital base, due to COVID, with local currency devaluations, share price collapse, and a heat wave of impairments that have come with COVID for their African clients. And came alongside this massive liquidity, short-term dollar liquidity squeeze, which is the lifeblood of trade finance. And addressing these issues is really where the international banks, DFIs, fintechs, and the likes of Mastercard, etc., and Asian development banks kind of come in.
Thanks very much, George. And a reminder to our audience as well, please feel free to use the Q&A box on the left-hand side or on the bottom of your screens to ask questions, which will help filter through later. This recording is also being recorded and streamed live on YouTube and Facebook at the moment. So back into the discussion and I guess the role of DFIs, MDBs. Nana, the MSME trade finance gap is $500 billion in Asia, and most definitely growing since the start of the pandemic. As a DFI, what's the role of ADB in supporting the real economy and MSMEs? And what are the biggest challenges for MSMEs, particularly over the last 6 months?
Thank you, Deepesh. Indeed, the great gap exists. We all know about that. And we have experienced a significant pickup in demand for our guarantee and loan product during the pandemic. And this is driven by the increased risk perception, which exists on the market within banks, and there is a higher need for risk distribution nowadays. To address the impact of the COVID-19, ADB announced a $20 billion support package back in early April, and $800 million portion of this package was for trade and supply chain finance program. This additional capacity helped to increase our support to our member countries, and as per our half-year results, the number of transactions supported increased by 80%, including around $400 million worth of COVID-19 related transactions, such as test kits, medical equipment, and others. During the same period, deals involving direct funding to our banks increased with about 89%. With this rate, we are expecting to support $5.5 billion worth of transactions in full year 2020. In order to address liquidity shortage on markets, we have signed new trade loan agreements with banks in Georgia, Vietnam, Mongolia, Uzbekistan, and have provided first Euro trade loan in Georgia. Aside from the financial support, we also saw need for the technical assistance during this period. We have been providing online courses in trade finance and compliance throughout this period in cooperation with ACAMS and ICC Academy to our partner banks. There was also lack of information on the description of the products, for example, related to the COVID-19. We addressed this and we have developed an interactive supply chain map of key COVID-19 products. Mapping these supply chains means that it helps banks, investors, governments, everyone who needs to access data to find quickly the description of the products and their suppliers, and they can reach out to those very easily. So the information is on our website, and it can be used by anyone free of charge. We constantly are updating this tool, and anyone can access it on the website of Trade and Supply Chain Finance Program of ADB. And most important, what I wanted to mention here is that we just recently merged two programs, program of trade finance and supply chain finance into one. So this will help us to provide more support to SMEs on our local markets. But first, we are providing a very deep dive technical assistance to local banks in those markets where supply chain finance is not yet regularly used. After 3 or 4 quarters of this technical assistance, we hope the banks will be ready to share risk with ADB in supply chain finance transactions. And with this, I hope that we will increase our support to SMEs even more further. Thank you, Deepesh.
Thanks, Anna. And the technical map, I actually looked at that a couple of months ago. Really interesting and very detailed. You can kind of log in, look at the various PPE equipment, the supplies, etc. It's a very interesting map, which we'll definitely link to later. So Claire, thank you very much for joining. I know Mastercard have been working very closely with DFIs such as ADB, which we will go on to discussing a little bit later. But just taking a step back and with your payments lens, how big is the problem and why are MSMEs left out of global value chains in the trade financing market? Claire. I think you might be on mute.
Hi, sorry. Hey, Deepesh. Look, we've just talked about kind of the extent of the problem. We know clearly with the pandemic. We heard from each of the regions how that is doubling, tripling. Severely, it is obviously getting to an extent that is exponentially a problem, which really means we have to act now. We have to act collectively and fast. If I think about building on kind of what George and Nana were saying about kind of the barriers to inclusion that we've traditionally seen, I think in addition to that, clearly this has been a segment which for financiers is an expensive segment to serve. And we've not seen the uptake because of that. But I think in our experience and the work that we're doing with ADB, done similar work in Africa, which we'll come on to a little bit later, is you've got to start thinking about how you're doing the financing process differently. And what I mean by that is really about using technology and data in a very different way. You know, we can't rely on the traditional ways of doing our credit underscoring. You know, one of the biggest inhibitors is many of these companies, the MSMEs, are clearly not on the digital path, right? They've not had the resources, they've not had the training to really get them digital. So for us, the focus is first, get the companies digital. And how do you do that? So really it's about then getting digital on digital payments, utilizing what data we do have, which is being exchanged between buyers and suppliers, and really taking that and using that as a proxy for performance and trading history. And then you can start using that for credit underwriting. So I think it's being a little bit more mindful, bespoke of thinking about kind of this segment and getting them more digital. And by doing that, there is a massive opportunity to be able to use both technology and data to profitably serve this segment. We're seeing it, you know, talking to large companies, talking to the SMEs themselves, and the pandemic is clearly fueling a change. It's not enough. The large companies are telling us it's not enough for us to be just in our supply chain finance programs only be financing the large suppliers. We need to go down mid-market. We need to go down to the smaller SMEs. We need to support our whole value chain and our whole supply system, ecosystem. So it's very, very much also being client-led that the impetus to change, and with what's going on in pandemic, has to happen. Thanks.
Thanks, Claire. And Chris, framing it from more of a regulatory perspective, has regulation failed this industry? Did Basel III or LDG requirements post 2008 really cause the trade finance dilemma we're now in?
Well, you know, you have to go back to 2008, don't you, to understand the current regulatory environment, current regulatory regime. You know, the regulations came in for a very good reason. Stability in the global markets was the #1 priority. But that came, as we now know, at a terrific cost to participation, particularly for SMEs. But not just SMEs, to a point that George rightly raised, also to secondary or second and third party banks who are actually supplying short-term working capital to SMEs on the ground, particularly in emerging markets. So if you look at the way that the regulations, for instance, impacted London, the banks here immediately then started to de-risk markets. Some banks were cut off from the flow of capital. And with that, the SMEs on the ground were immediately cut off from access to finance. And so I think, you know, 12 plus years on, and in the current, you know, economic climate where economic growth in every form is the absolute urgent priority for all of us, it is time to review the regulatory regime. And I don't think what we should be proposing here is a revolution. What we're saying here is actually there is no evidence, as we know from ICC's trade finance surveys and risk registers, to support the treatment of trade finance in the same way as other forms of higher risk finance. And so I think it is a time to have a more proportionate regime around low-risk trade finance, and in doing so, bring more capital into the market. You know, the trade finance gap has doubled during COVID to 3 to 5 trillion. In our estimates, if you employ a more proportionate regulatory regime, you could put 2 to 3 trillion of that gap straight into the market, much of which would go straight into the emerging markets where it's most needed. You know, as in always with these kind of cases, it's the poorest get hit the hardest, and it's SMEs who get hit the hardest. And so I think there is a real case now to say it's time for change, a more proportionate approach. Let's, you know, maintain stability, but do it in a balanced way, and ensure that participation is also a key priority.